My name is Mark Cooter. I'm a tax partner with Cherry Bekaert and leader of our real estate and construction industry group. We're excited to have those of you who joined us on Tuesday and Wednesday back for day 3. For those of you who are just joining us for the first time, welcome. Our virtual conference features 4 presentations on a variety of hot topics, recent developments, and proposed updates tailored to the real estate and construction industry. We're excited about the lineup we have planned for this week, and we'll be offering up to 1 hour of CPE per session. We hope you're able to join us for all 4 or for our final session tomorrow. Here's a quick housekeeping. Before we get started, here's some quick housekeeping. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50 minutes. CPE certificates will be issued via email within 10 days. If after 10 days has not been received, please email cbhlearning@cbh.com. At the end of the session, once you are exiting, a short survey will be posted at the conclusion, where you'll be able to give us some feedback about today's webinar. A recorded version of the webinar will be available in about a week, and it'll be sent via email and posted to our website. If you have any questions during the webinar, please type them in the Q&A window located in your control panel. We'll try to get to those during the Q&A session. And with that, I'm going to turn it over to Jason Hall and Michael Elliott, who will review some tax saving strategies and year-end planning ideas for 2021. Jason?
All right. Thanks, Mark. Appreciate it very much. Go back one slide. My name is Jason Hall. I'm a tax partner in the Raleigh-Durham area. I've been doing real estate pretty much my whole career. Started on the West Coast and then gravitated to the East Coast. Love tax planning and looking forward to talking to you guys about things today. Hopefully a few things you haven't heard and probably a few things that you have. Mike, do you want to introduce yourself?
Oh, yeah. Hey, thanks, Jason. So I'm Mike Elliott. I'm the tax director in our Tampa office. And like Jason, I've been doing real estate my whole career. I'm actually currently the firm partnership expert, but really real estate is my bread and butter. That's what I've done my whole career, and I enjoy this planning stuff as well. So I'm enjoying just the opportunity to speak to everyone about this, and hopefully you'll all have some good takeaways for what to expect for next year.
Nice. So goals for today, we always need some goals. We're going to talk about Build Back Better briefly. There's been so many changes and so much buzz and so much about tax changes, tax law changes. And Build Back Better has gone through multiple changes and is still with the Senate at this point, not completely cleared. And we have no definitive things related to those changes, but we wanted to kind of give you an overview, give you the update. Then we want to talk about some things that we do know are coming down the pipe so that you can actually plan for them, like interest expense limitations and pass-through entity issues that we see that we know are coming. And then give you some other planning tools, some tidbits, some help that you could maybe talk to someone about, talk to us about, because the planning piece is super important, not just now before December 31st, but even some things that you can do after that time period that apply to this tax year. All right, so getting into it, this is we want to talk first about what was dropped, because if you've listened to things in the news, there's a $3 trillion plan out there, and then it got chopped in half to a $1.75 trillion deal. And some of the things that got dropped from that deal are on this slide right here. Some things that a lot of my real estate clients were very worried about, like capital gain rates going up and marginal rates for individuals. But some of those are still in play. So these are the ones we got dropped. Section 199A limits got dropped. Estate tax basis step-ups getting eliminated. That was dropped. Section 1031 exchanges going away. That got dropped. And carried interest rules. We're going to talk a little bit later about some carried interest points. But they wanted to extend that to a 5-year hold on carried interest before they can be long-term capital gain, and that got dropped. All these things got dropped. There are things that also got not dropped, if that's a thing. And so we want to bring those to everyone's attention, because you don't want to get stung by that come April 15th and say, oh, wow, I never knew that was coming. So the net investment income tax, some things that are included in there that you might not think are included in there. Generally, we think, oh, it's only passive activity stuff. I'm not going to get stung by that. But something still in the Build Back Better deal is that all passive and active business income is includable, and also gains on partnership interest sales and stock sales. Those would be included also. We have excess business loss limitations. Those are still on the table, making those loss limitations permanent and having them not flip from NOL to be an NOL, but to carry on as just a business loss. R&D tax credits, there's a delay on the capitalization there. You may wonder, well, why the heck's R&D on here when we're talking recon? Definitely, please talk to us about that if you don't know, but there are some, especially construction side opportunities there to actually potentially claim R&D credits. And Section 1202, those changes did not get dropped. Some of the, I'm going to turn it over to Mike, I think, at this point.
Oh, okay. No, thanks, Jason. And Jason actually touched upon some of this just quickly. So we're going to talk about the net expansion below, but yeah, one of the things that we're going to see here. So there's a lot of talk about this billionaire's tax, but it's not necessarily a billionaire's tax. They've kind of ratcheted that back. That was just some rhetoric, I think, for just for the media. What it really is what they're calling a high income earner tax. And so when we said that they weren't going to change the top marginal rate, but what they are talking about doing right now is just if you're a married couple filing joint, they consider you a higher income earner if you have 10 million of modified adjusted gross income or more, or if you're single, then 5 million would be the threshold. Any modified adjusted gross income that you have above these threshold amounts is going to be subject to an additional 5% tax. So it's like a surcharge on top of whatever your marginal tax would be at the current rate. So they aren't changing the top marginal rate. That's going to stay at 37%, but you are going to see a jump to 5% on anything over 10 million. And then they're talking about an additional 3% surcharge in excess of 25 million for a married filing joint, or 12.5 million for single. So, again, I think every dollar over 25 million, or if you're in that boat, you're going to see a potential 8% surcharge on top of the top tax rate. And on top of that, now we've got this 3.8% net investment tax. In the past, that hasn't really applied to passive income. And if you're active, you have self-employment anyway. But now any kind of trade or business income that you have, regardless of whether you're active or passive, you're going to either pay self-employment, or you're going to pay net investment tax. So at a minimum, you're going to pay that 3.8% tax on it. And furthermore, even if you have a gain on the sale of real estate, it's trade or business property. So even though it's going to be taxed at capital gain rates, it's still going to be subject to that 3.8% additional net investment tax on top of it. So these are some of the things that are coming down the pipe. So that's the bad news. The good news is that we don't have any other marginal tax rate increases. And if you're under these threshold amounts, well, again, that net investment tax thing actually applies if you're only 500,000. Basically, any income that you have over 500,000, if you're a married filing joint, or $400,000 single, that you're going to see that 3.8% hit on passive income where you're currently not being taxed on it. If you're active, you're not going to really see a difference there. But again, I think if you're in those upper threshold amounts, you're potentially seeing as high as an 8% increase there. But again, they're not going to touch long-term capital gain rates unless you're over those thresholds. Because if you're over the thresholds, it's going to apply to all types of income. It doesn't matter whether it's ordinary income or capital gain. You're going to see these surcharges on top of it. But they're not planning on any other rate increases, and they're not raising corporate rates either. Next slide, Jason.
Hey, Michael, while you're going to the next slide, a question's been asked about whether the rate increases are impacting or the surcharges are impacting trust income.
Oh, sorry, Mark.
Looks like it's been answered, so disregard. So.
Oh, I got you. Okay, great. All right, so I guess it's time for our first polling question here. And so I think we're going to hopefully okay, great. All right, so we're going to give everybody 60 seconds to answer this. Let's just get these responses in as quickly as possible.
And Mike, I've had a few calls lately that people have brought up this additional 3.8% on things that they're not used to paying it on. So it definitely is something you want to plan for. I think something that a lot of people focus in on is one aspect. And so what hopefully we can do, because in some manners, it's better to accelerate income into 2021, right? For and defer your deductions. And then in other cases, it's the opposite. So, I mean, you really want to look at it as a whole big picture, not just one little piece that you're focused in on, because it can go both ways, and you definitely want to do some analysis.
Absolutely. All right, so looks like we have all of our responses in now. Okay, great. For those of you who answered all of the above, you guys are correct. But that's it. It does apply to all of the above. So let's move to the next slide. Oh yeah, here we are. Yep. Okay, so let's talk about what's in the House Build Back Better bill. So we talked about the tax rate increases, which is in there, but there's some other things as well, which don't really deal with tax rates. Now, there's this concept of excess business losses, which was introduced as part of the 2017 law. That was actually set to expire, and now they're going to make that permanent. So that's not going away. It was going to go away, I think, after 2025. Now it's going to stick around. But one of the changes that they made was that if you had an excess business loss, you had to net all of your business income and your business losses together. No limit on business losses to the extent it offset business income, and then you could deduct an additional $250,000 for a married filing joint couple. But that would be it. Any losses that you have above a net $250,000 loss would be considered an excess business loss, which would get carried forward. But it will become part of your net operating loss the following year. And then that could be subject to a limit of an overall 80% of taxable income. So that was what was happening with the prior, excess business losses. So, but starting in 2021, that's not going to happen anymore. 2021, if you have an excess business loss this year, it'll continue to be a business loss when it gets carried forward, and it's not going to be subject to that limit anymore of 80% overall of taxable income. You're still never going to be able to deduct more than $250,000 of excess business loss every year, and that's going to include all your carryovers from previous years. But at least it isn't going to be subject to a further limit as part of your NOL. So that this could help you or hurt you depending on what your fact pattern is. Now, the other thing they're talking about doing, and I don't know that people are going to really see a big impact on this, and certainly won't in 2021. This is going to be after 2022, so it won't be for next year. It might be in 2023. There's a limit on business interest expense right now. Currently, if you hold real estate or construction, whatever, through a partnership or S corp, this limitation actually applies at the entity level. So the entity may be denied an interest expense deduction. They're going to do away with that entity level limitation, but what they're going to do is they're going to force the partners and shareholders to calculate the limitation on their own return. So ultimately, you're going to be limited on your own return anyway, even though it's not going to be happening at the entity level. I don't know that anybody's going to really see a difference net in terms of tax, but the mechanism for calculating it will change, at least according to the current bill. So next slide. Jason, I'm sorry. Next slide. Oh, there we go. Yeah. So how do we minimize the impact of the rate increases? And first, let's talk about what kind of rate increase am I facing. So if you have active trader business income, and if you're over those high income threshold amounts, you're going to basically look at a 5% rate increase on any amount that you have over the 10 million, regardless of what kind of character it is. That's what you're looking at. But if you have active trade or business income and your AGI is over 25 million, if you're in that upper high income threshold amount, then you're looking at an additional. Actually, this is a typo here. It should be 5% rate. It's not a typo. 5% rate increase on anything above 10 million and under 25 million. But then you're looking at an overall 8% rate increase on the amount of over 25 million. Now, if you're in the passive category, now you're currently not being subject to self-employment tax or net investment tax income, and if you're over these threshold amounts, you have to remember you have that additional 3.8% tax on top of the surcharge. So you're looking at an 8.8% increase on the amount over 10 million. And if you're between 10 and 25 million, you're looking at we'll call it 8.8%. For anything between 10 million and 25 million, and 11.8% for the amount over 25 million. So these are pretty substantial. Now, so generally speaking, looking at that kind of rate increase, if this is going to apply to you, you may want to accelerate as much income as possible in 2021 because it's still going to be taxed at a lower rate in 2021, even though they're not changing top marginal rates. And you might want to defer deductions as much as possible to 2022 because the idea would being, maximize your income now and minimize your income later. And that would be the best way to do it from a strategy standpoint. There are other things to consider, though, which we'll get into on the next slide, that may not be a catch-all. So let's talk about the business interest expense limitation. Now, many of you may be familiar with the fact that as part of the Tax Cuts and Jobs Act, for any year beginning after 2017, they started putting a limit on the amount of interest expense that you'd be able to deduct. And what it was is, at least as part of the original law, it was 30% of your what we call adjusted taxable income. Now, what adjusted taxable income is basically EBITDA from an income tax basis perspective. In other words, you wouldn't include depreciation or amortization or interest expense in there. Or taxes or anything like that. It would just be added back, and it would just be you'd be able to deduct 30% of your EBITDA, basically. To the extent you had business interest income, you could offset that completely with interest expense. Now, floor plan financing interest expense, that's not really going to apply to most people in the recon industry, but that's part of the law. There's no limit on that. That really just deals with more auto dealers and things like that. They can deduct their interest expense on floor plan financing without any kind of limit. But as far as business interest expense that's not floor plan financing interest, that's still subject to that 30% of EBITDA limit. Next slide. That was the original law. And then what happened is we got hit with COVID. So the CARES Act came out and Congress decided to provide some relief. But in their infinite wisdom, they decided to make this thing way more complicated than it needed to. So for all taxpayers other than partnerships, and I don't know why they treated partnerships differently, it just doesn't make any sense to me. But for 2019 and 2020, for everybody but partnerships, what they did was they limited they increased the limit from 30% of EBITDA to 50% of EBITDA. For partnerships, they didn't do that. Partnerships were still subject to 30% in 2019, but then in 2020, partnerships also got the benefit of that 50% of EBITDA. But everybody has to remember this. 2021, we go back to 30% of EBITDA. People may not be aware of that. So all of a sudden now, you may see this is what it was always supposed to be anyway. That 50% limit was really just a short-term. That was really just a short-term relief provision as part of the CARES Act. It doesn't apply for 2021. So again, this is already part of what's in the law anyway. But you're going to see an increase. You're potentially going to see a loss of interest expense deduction when you compare your 2021 return with your 2020 return, because it goes back to 30% for everybody. So that's already happened. Next slide, Jason. So now it's time for our next polling question. So we'll just leave this open for 60 seconds, and you guys can answer this, and then we'll move on after that.
I think what we're going to do is talk a little bit later too about making an election or not making an election related to in business interest expense deductions for specific, right, Mike?
Yeah, absolutely.
Yeah. Yep. All right. We have most of the people have answered, I think.
All right.
I think the majority of people picked B for that.
The next slide, please.
Right.
All right, so that last question, unfortunately, was a little bit of a trick question because we haven't told you everything you needed to know. So for those, we did see a lot of responses. Everybody was basically saying that that after 2021, it goes back to 30% of EBITDA. But what we didn't tell you yet, and this is the bad news, is that in 2022, and this is written into the law back in 2017, they've actually changed the definition of adjusted taxable income, beginning in 2022. So prior to 22, it was EBITDA. It actually becomes EBIT in 2022 and thereafter. So in other words, you have to actually reduce your adjusted taxable income by depreciation, amortization, and depletion. And so it's really just going to be your earnings before interest and taxes, and that's it. So now what that basically means to everybody is that any depreciation, amortization, and depletion that you deduct after 2021 is going to reduce your ATI or reduce your EBIT, and that's the base on which the limitation is calculated. So potentially every dollar, and let's go to the next slide. You're potentially going to lose interest expense deductions for basically 30% of your depreciation and amortization and depletion that you take after 2021. So just to kind of show you what this looks like, if you want to compare 2021 versus 2022, all things being equal, just assuming that you, without any kind of limitation, you'd be looking at a taxable income of about 2.5 million, which only includes like 2,000 of interest income. And as we said, that you can offset interest income completely with interest expense. But effectively, the way this works is that you have to look at your adjusted taxable income under the old definition. And the way this would work out, it would be 7 million when you add back your depreciation, because that, again, depreciation does not reduce your ATI before 2022. So under the old rules, there would be no limitation for this particular taxpayer. They'd be able to fully deduct their interest expense because the interest expense is only 2 million, and they could have deducted as much as 2.1 million. So there's no limit here based on the old rules. But when you get to 2022. Now, suddenly you don't have to add back your depreciation expense anymore. So notice how the depreciation expense reduces your ATI down to 4.5 million, and you're only getting 30% of that. So in this case, you're going to lose $648,000 worth of interest expense compared to the previous year. You're going to be limited in terms of how much you can deduct. You only get to deduct 1,352,000 of your total 2 million of interest expense, and the 648,000 gets disallowed and carried forward. So you're potentially looking at additional tax on this this interest expense deduction of about 136,000. So this could be pretty substantial. Next slide. Now, what do we do about
what we're saying? Oh, so, we're going to get to it here, I think. Yep. Okay.
Yeah. So one thing you might want to consider now, knowing that now again, we did tell you before that if we're going to see a potential rate increase, if you're in those upper limits, you have to kind of consider, this is going to be beneficial to you, because normally we would tell you, look, if tax rates are going up, try and defer your deductions and accelerate your income. But you do need to consider the interest expense limitation, because deferring deductions on depreciation and amortization and depletion could actually be very detrimental to you, because you're going to lose 30% of that in terms of interest expense, because of the way they're redefining your adjusted taxable income. And that's that's the base on which your limit is calculated. So what you can do here is by accelerating depreciation, that's going to increase your adjusted taxable income for later years, because what it does is it keeps the depreciation deductions out of those years. And it reduces it in 2021, but that doesn't hurt you, because again, you would add back any depreciation you take in 2021 for purposes of calculating the base, in which the 30% is calculated. So take all the depreciation you want in 2021. It's not going to impact your interest expense deduction at all. It will after 2021. So again, that could be 30 cents on the dollar for every dollar that of depreciation or amortization or depletion that you can accelerate. The other thing you want to consider, and this applies for real estate businesses only, and many of you know this already, you can make a one-time election out. It's irrevocable once made. That you're not going to be subject to these interest expense limitation rules, but there is a cost for doing that. So what the cost is there is that you're going to have to use something called the ADS, which is alternative depreciation system. It actually requires you to use slower lives for depreciation methods on your real property. Now, it isn't that much longer. I mean, in the case that if you have a non-residential, you're going to go from 39 years to 40 years. If it's a residential, it's going to be 27 and a half to 30. That's not really the big cost, though. Where you're really going to take a hit, though, is that once you use ADS, you can't take bonus depreciation anymore. So if you have a lot of leasehold improvements, anything that would meet the definition of qualified improvement property, right now, if you have qualified improvement property, you can take 100% bonus depreciation on it if you're not using ADS. Once you use ADS, you can't do that anymore. So what we're going to say is, if you're thinking about electing out, you may want to hold off on electing out until 2022 if you haven't already done so, assuming you're not losing that much interest expense to begin with in 2021, because then you can take bonus depreciation, all this stuff in 2021, write it off, and then you're not depreciating it after 2021. So next slide. This is what this would look like. Let's just assume that we were able to find a way to accelerate about $2 million of depreciation expense from 2022 into 2021. If we found a way to just speed it up, maybe and we'll get the ways that you can speed up depreciation or accelerate it later. But let's just say we were able to find a way to do it. Or even if we had equipment purchases that we were expecting, that if we could accelerate those purchases and place them in service before the end of 2021, we'd be able to take bonus depreciation on it. Look at what kind of an impact this has. So in the previous slide that we showed you before, we were comparing 2021 to 2022, we had $2.5 million of depreciation expense per year, $5 million in total. What we've done is we've accelerated $2 million into 2021. So now you only have $500,000 left in 2022. Under this scenario, you're really not losing very much interest expense at all. In the previous slide, you were going to lose about $648,000. Now you're only going to lose $48,000, because by accelerating $2 million into 2021, it didn't hurt you for 2021, but it actually helped you greatly in 2022. Next slide.
Yep. So that's definitely important to think about when you're year-end planning, right, Mike? I mean, if you're talking about depreciation, we're going to talk about that, like, and when that can happen. I think the next slide, carried interest rules. Carried interest rules have been around, and it's been on the chopping blocks multiple times, like throughout tax law history. The current rules, the new regulations came out in 2021, and they kind of, and like we said earlier in this presentation, they were going to change the hold time from 3 to 5 years, but as the slide says at the bottom, that got dropped. It did. The most important part is, carried interest rules. We don't like when it's flipped to short-term capital gain versus long-term capital gain. We want to try to qualify all the time for the long-term capital gain treatment. So the regs came out, they defined what qualifies as a carried interest. And then what comes in our favor, real estate world and in the space, and what I've had many calls on related to it under the exclusion to these rules, and specifically the first bullet under here. And I know most of you probably aren't code section. You don't read the code, Internal Revenue Code on the weekends. That's okay, because you just need to remember section 1231 or trade or business gains. Gains or losses from the sale of trade or business property. And so hopefully, as real estate professionals and real estate groups, you are developers and construction, you will hopefully qualify for this treatment, because this treatment will allow you to then say, okay, I'm not subject to the carried interest rules because I sold trade or business property. I didn't sell, a passive investment that I'm part of. So that first bullet, I believe, is probably the most important part about carried interest rules that we wanted to talk about today. The next slide talks about like-kind exchanges. Finally, we have a definition of real property related to like-kind exchanges. I have multiple clients that do multiple like-kind exchanges every year where you're able to defer the gain related to the sale of a property by reinvesting it in more real estate. And that's something that changed under some older rules that, we used to be able to like-kind exchange trucks and equipment and other things. Now it's only real estate, and now they've provided a definition for real property. And so those bullets that you see there are the main categories. And even airspace, like above your land, was sometimes tried to be treated differently than and sold differently than the land underneath it. Something also quickly to note, that these regulations provided the definition for incidental personal property. Oftentimes, when you go into real estate, there are items that are treated differently under like-kind exchange rules. Cost segregation is a great tax planning tool, but it also categorizes or moves assets from the real property bucket to other buckets. And so we want to know if that's incidental or not. Oftentimes apartment buildings will have some issues there with all of their appliances and their non-real estate assets. So we still are highly recommending, though, looking at cost segregation as a tool to help accelerate depreciation. And so so it's always important to remember the play between like-kind exchanges and recapture of depreciation, because under cost segregation, you're trying to speed up depreciation on different types of assets that you're breaking out that aren't really real estate. But then there is recapture on those assets. So you really want to be mindful of that. Something else that's changed quite a bit is something called the pass-through entity tax. And this is really a state tax situation. So a few years ago, maybe more than a few of you felt the pain of on your federal taxes only being able to deduct $10,000 of any type of state taxes. And so the states have tried to get tricky, and they've tried to work around that federal kind of limitation on deducting state taxes. And so what they've done is several states, probably about 20, and I know North Carolina just passed their legislation in the last few weeks that has said, well, okay, if individuals are not able to deduct their state taxes on their individual tax returns, we want to provide a way for them to deduct them or get a credit for them on their pass-through entity tax returns. So very important for all of you, planning-wise, to see if it's worth making this election. And the states have kind of gone, like I said, the two directions. One is to provide a tax credit for their share, for an individual share of the tax paid by the entity, or they're going to say, we'll reduce your state taxable income by the amount that was taxed on the pass-through entity's tax return. So that can be a big deal, especially if you hold real estate in California and New York and other states that are definitely high income tax paying states. So for sure, we've got together kind of a list of states. Yeah, you can spend a second looking at this. I believe the slides will be available to everyone as well anyway. So, but again, the states with high income tax are the ones where you could consider making this election. It's very similar, you guys, to composite tax return. At least that's the way it feels to me as far as paying it. That composites are different because individuals still get credit, but here you want to make this election if you're extremely limited on your individual side tax returns. So you'll see here, New York's on here, California's on here. Some of the bigger, higher taxed states. Something we also wanted to definitely make you guys aware of. We're not going to talk about it, but if you have any international partners or any international entities in your structure, please be aware that there are new forms out there. There are new requirements. There are pages and pages of new fun to be had by your preparers, your tax preparers. So please don't forget about those. Again, we're not going to really talk much about them in detail here, but some of your structures, and you really need to know your structures at what level and how these when these forms come into play, so that you can, because unfortunately international tax reporting has some pretty stiff, heavy penalties related to it, for sure. So don't forget about that. I think we're going to talk a little bit more about accelerating some deductions. So I think, Mike, I'm going to turn it back over to you.
All right, thanks, Jason. So anyway, so we mentioned before accelerating deductions, which again, you gotta understand your situation and understand if this is something you want to do or don't want to do. You have to think in terms of, well, am I going to see an overall rate increase or not? If you're not seeing a rate increase and you're looking at this interest expense being further limited because of that whole EBIT thing I told you, this would be a great way to do it, because this is going to focus on ways to optimize your interest expense deduction. So if you're trying to accelerate depreciation, amortization, or depletion into 2021, the best way you can do that, single best way we can think of, is a cost segregation study, if you haven't already done one. And what that would do is you'd try and reclassify what's currently considered real property. Try and reclass as much of it as personal property as you can, because anything that you can do, anything you can reclassify as personal property, that's not going to be subject to ADS going forward, because again, if you make that election, that only applies to real property, not personal property. So the idea is classify as much as you can out of real property and into personal property, because the other benefit you have is that you can take bonus depreciation on personal property without any kind of limit, and then you don't have any depreciation on it at all after 2021. Now, real property, there is a special category of real property that meets the definition of qualified improvement property. And we're not going to get into what that is specifically. It could be some portions of the inner portion of the building. Certain things are excluded, but certain things are included in it. If it meets the definition of what we call QIP, that would also qualify for 100% bonus depreciation. And so if you haven't elected out already out of the interest expense limitation rules, and if you're not really looking at much of limitation anyway in 2021, even if you're being slightly limited, it may be beneficial for you to just continue to be subject to the interest expense limitation rules in 21, but then take this bonus depreciation deduction on qualified improvement property, because then that's going to allow you a big deduction now, and it's going to keep all that depreciation out of your future years, and it's not going to hurt you for the interest expense limitations going forward. Now, the other thing you can do is you could wait until 2022, and then you could elect out of the interest expense limitation rules anyway. And then you won't care because you've already gotten all your depreciation on your qualified improvement property at 100%. You won't have a slower life left to depreciate on any of it. It won't really hurt you. And then you can deduct all your interest expense going forward without any kind of limit. So that's one thing you do. Now, similar to a cost segregation study is what we call a fixed asset study. We would go and look at things that didn't have to be capitalized in the first place. You might have some things on your depreciation schedule that that really didn't need to. Maybe they met the definition of a repair. Maybe you're overly conservative when capitalizing these items in the first place, and they may meet some of the exceptions in the regulations that didn't require them to be capitalized, and you could write them off as a repair. And then further on that, not just this fixed asset studies, we also do something called a fixed asset review, where we're just going to look at the depreciation schedule in general. We may be able to identify things that were disposed of previously, and then just write them off. Maybe some things that were on your schedule really didn't have the right class life on them. Maybe we can optimize them. Even if we're not segregating costs, we can maybe reclassify certain assets, and then just take advantage of additional depreciation that could have been taken. And what that can do is basically accelerate those deductions into 2021. And we could do it as an accounting method change, where you just take the benefit in 21 and write everything off then. And then that way it keeps all that depreciation out of the future years. And then the third one, this is probably the easiest thing to do. If you're expecting to have a major equipment purchase or major capital expenditures that you have in the near future, anything that you can accelerate and place in service prior to the end of this year is going to accomplish that same thing. At least if you can take bonus depreciation out, you can write it off in 2021, keeps that depreciation out of future years. And even if you can't, you're getting started on depreciating it sooner. And then anything you take in 21 will help you in terms of that, making sure that you maximize your EBIT later for purposes of calculating the limit. Next slide.
So Mike, really quick too, if I'm right, that you're able to do cost segregation studies post December 31st, right? And
you can, absolutely. Yes, I'm happy you brought that up. You got to do it before the tax return is filed, obviously, but you don't have to actually do the study before the end of 2021.
Okay.
You just may want to start thinking about it and just
sure.
Don't try and get a cost seg study a month before your tax return is due, because you may not be able to have enough time to get it done.
That's right. That's right.
It takes a couple of months depending on how involved it is. So just give yourself plenty of time if you're thinking about doing that. Yes.
Correct. But the purchase of assets should happen before December 31st. Mm-hmm. There's two things on the calendar you need to have going. So definitely it's different, but you're trying to accomplish the same goal, right?
Yep.
All right.
You got it. So that's an idea. Again, we would look at we would do accounting method changes if there were things that happened prior to 21 that maybe need to be corrected, where we can, just because you didn't buy your building in 21 doesn't mean that we can't do a cost seg. We can do a retroactive cost seg study going back to when you first bought the building and figure out what part of that original building would have qualified as personal property. And then maybe there's been things capitalized along the way, and we can actually do a retroactive accounting method change to catch up on all those missed deductions. And then there's other accounting method changes generally that could accelerate deductions or maybe defer income if you want to do that. So, for example, if you're looking at a rate increase because you're in that upper income bracket, and if you're currently on the cash method, you might want to go to accrual method because that may cause you to accelerate some more income. If you're already on the accrual method and you want to maybe defer income by going to cash, that's a little bit more challenging, but it still can be done. You have to apply for IRS approval for that. It's not automatic, but it can be done. And there's also other accounting method changes that you can make. If you're in the construction industry, there's a percentage of completion versus completed contract, which can change the timing of how you recognize income and deductions if you qualify for some of those for either of those methods. Sometimes you wouldn't qualify. But if you qualify to make a change, you may want to think about it if it helps you there.
Yep.
Okay, next slide. And now it's time for our next polling question. So we'll put that up and we'll give you guys about 60 seconds to answer that. Right after this, I'm just going to turn it over to Jason for a few more ideas.
Okay. I don't want to. We want to for the last few minutes that we have, you guys. We definitely talk about some other things, kind of some hidden gems, things you might not have ever heard about, but you probably have some of them, and others you might not have. Things that I have found in the real estate world have generated big savings for my clients that hopefully we can help you guys talk through at some point, or and hopefully people will be able to implement some of these things. All right, I think the polling is done. Most everybody chose all of the above. That's great. And so I think the next few slides, we're going to just talk about some other planning tools. So the first one that I wanted to talk through is deducting dead deal costs. So definitely scouring your balance sheet for things that have been capitalized is very profitable. Please don't forget to go through your balance sheet, and when you're capitalizing development, you're trying to go after new projects and you're capitalizing the things that might get reimbursed later, and then maybe that project doesn't happen. I think especially with COVID and the changing landscape of things, deals don't go through sometimes, and oftentimes there are costs still left on people's balance sheets. So definitely, I hope that that's something, and you got to be careful. There are very, very strict rules on deducting things. You're not able to continue to go after that project, right, and still deduct these things. So being careful and following the rules, but being able to say, no, this one is a dead deal, even for now, like to say maybe in 10 years I'll go after it again, but definitely that's important. Another planning tool that we've seen Mike just mention is completed contract versus percentage of completion. That is an interesting tool in and of itself, where sometimes developers and construction groups have long-term contracts that aren't being treated correctly. And there may be opportunities, especially if you're what's considered a small business taxpayer, to defer income or speed up income. So please don't think, I've got it. I've been doing it the same for 20 years. It's good to look through your WIP schedules and kind of see if there aren't opportunities in there. Entity selection, that's still not off the table in my mind. It's interesting to note that, when you go from one entity type to another, there are tax implications, tax fiction, they call it sometimes, deemed sales that happen. And there are times when you want to trigger those events so that you are triggering these deemed sales potentially maybe sometime, hopefully you don't have it, but if you had properties underwater, things like that. So entity selection, don't take it off the table. Always talk about it. See if you're in the right entity type: C corp, S corp, LLC, limited partnership. And then, one of my all-time favorites is retirement plans. I have seen some extremely large developers with 0 retirement plans in place, like none. And so we want to let you know, especially now, that it's not too late. And even after the year ends, for some plans, it's not too late for you to set them up, get them in place, and create deductions related to retirement planning. One of my very favorite ones is on the next slide, and we are running out of time, I believe. But it's called V.I.P, Direct Recognition Variable Investment Plans. If you haven't heard of this, and I hope all of you think you're a VIP. I think everyone hopefully treats themselves as a VIP, but if you haven't heard of these plans, they're big. I mean, if you just looked at the last bullet on this slide, you can contribute hundreds of thousands of dollars to these retirement plans where, general 401ks and profit sharing, you're capped out at much lower amounts. So you have got to think of other things sometimes when you're doing tax planning, especially if you're popping transactions in a year that will pop big capital gains or big development fees. You want to have things in your arsenal like VIP. These things I've found have saved just tons of money for my clients. And while these are used a lot with attorneys and doctor groups, it also applies to the real estate world. It applies to any group that has excess cash or is going to be extremely taxable. Happy to talk through all of those rules with anybody who wants to have them. I think we want to get to our last polling question as quick as possible. Just a quick note, D is not the right answer. That's what my kids hate, is when I try to slide vegetables in the pasta. Don't pick D. Anyway. And we have to give you a minute to answer these questions. But in general, I don't know many people. A lot of banks try to push things called cash balance plans. These are different than cash balance plans. These are defined benefit plans that don't have as severe of risk for underfunding. They just are an all-around better plan. And the way that we implement them, the IRS pre-approves the plans that are designed for clients, so that it really is a slam dunk in that regard. I think everybody has answered the right answer. The variable investment plan is the right answer. And so I think that brings us to the end of our presentation. Again, write down our emails. You can call Cherry Bekaert at any time to talk to us about questions you had about this presentation, other things you're thinking about. We're happy to help anytime. Thank you so much for your time.
All right. Thanks, Jason and Michael. We appreciate that. That concludes our third session of the conference, and thank you again for joining us. As mentioned before, we will be distributing out access to this webinar, a recording of the webinar, so you can go back and review something that you'd like more information, or please feel free to reach out to Jason, Michael, or myself if you have additional questions regarding today's topic. We value your feedback, and once again ask that you take part of a short survey which will appear when you leave the session. And our final webinar will be tomorrow, Tax Advantage Capital Sources for Real Estate Development. Will be tomorrow at 10 a.m. and we hope to see you then. Appreciate it. Thanks, everyone.